Fabrinet delivered the kind of headline quarter investors normally reward, but the stock still lost roughly 1/5 of its value. That disconnect is the story. Demand is clearly growing. Now Fabrinet must prove that rapid expansion and new capacity can produce durable cash flow. This is educational research, not financial advice. Please verify all data independently. Expectations were already demanding before the release. Investors wanted another strong quarter from data center optics, but they also wanted evidence that growth could support the stock's premium valuation. That made cash conversion almost as important as revenue and earnings. The headline result was a clear beat. Both revenue and adjusted earnings cleared consensus, while year-over-year growth remained exceptional. But a beat only matters relative to what the market had already priced in. Here, the quality of growth became more important than the size of the surprise. The first reaction was negative, and selling accelerated during the next regular session. Investors focused on negative quarterly free cash flow and the limited room for disappointment created by the starting valuation. Broader weakness in AI-related stocks added pressure, but Fabrinet's cash flow gap gave the market a company-specific reason to reset expectations. Growth was broad across Fabrinet's two most important end markets, supporting the view that demand is more than a one-product spike. Still, Fabrinet does not disclose a separate AI revenue figure, so the AI connection should not be overstated. Heavy customer concentration also means a few large relationships can materially shape results. The quarter exposed a sharp gap between accounting growth and cash conversion. Fabrinet spent aggressively on capacity and carried much more inventory, while gross margin remained thin. Those investments may support future shipments, but until they translate into cash, investors must carry more execution risk. Management's outlook still points to another sequential high, so the sell-off was not driven by an obvious demand collapse. The real test is whether another record revenue quarter also improves margins and cash generation. Strong guidance now needs to be matched by stronger operating quality. Management's message was that growth drivers remain intact and capacity is being built for the next phase of demand. The market's response was more cautious. Full-year free cash flow was minimal despite rapid expansion. Investors now need evidence that the capacity ramp can generate cash as shipments scale. The good news was straightforward. The company beat expectations and still sees another step up in revenue. The disappointment came from how much working capital and investment were required to support that growth. This is why excellent headline results did not protect the stock from a sharp repricing. Before earnings, the thesis centered on AI-linked optical demand and a longer runway from capacity expansion. That demand thesis survived the report. What changed is the burden of proof. Inventory and capital spending must now produce better margins and free cash flow. The bull case is that exceptional growth and another record outlook signal durable demand. The bear case is that thin margins, weak free cash flow, and customer concentration leave little room for execution mistakes. Both cases remain credible, which means future results will matter more than the AI label alone. Most analysts in the August snapshot still carried positive ratings, and the average target remained well above the post-earnings close. But the wide target range reveals substantial valuation disagreement. These targets can lag new information and change quickly. They are neither company guidance nor a forecast of where FN will trade. The next report should be judged less by another revenue record and more by operating follow-through. Watch whether gross margin stabilizes, inventory begins converting into shipments, and free cash flow rebounds. Together, those checkpoints will show whether Fabrinet's capacity investment is working as intended. Fabrinet scores highly on the headline beat, demand momentum, and forward guidance. Profitability is more mixed, while execution receives the lowest mark because inventory and capital spending have not yet translated into cash. The verdict is strong earnings, but an incomplete cash conversion story. Thanks for watching. Like, share, and subscribe. Then visit AIStockshub.com.